Okay, so you've learned a lot so far, right? We've covered, the basics of stock trading. What is a stock? We talk about fundamental analysis, technical analysis, risk management, and I know, right? There's a lot to swallow at this point in time. So I just want to kind of piece the puzzles together so you can see the big picture, right, of what we are trying to accomplish over here. So let me just do it, right, by showing with you a trade example, right? A simulated trade example. Okay, so let's say this is the chart of Coca-Cola. Let's assume that Coca-Cola, it's a fundamentally strong company, right? Let's say earnings is improving, revenue is beating analyst estimate year on year, and all the good stuff is coming out of Coca-Cola. So that is a good piece of fundamental, and that is a stock that we want to focus on. Next thing, we look at the technicals, right? So we look at Coca-Cola and we notice that this market, I think it's in an uptrend, right? Let me just pull out the 200 MA and see whether the price is above it. So as you know, right, we can define the long-term trend using the 200 MA. If the price is above the 200 MA, we want to be a buyer. If the price is below it, we want to be a seller, or at least just stay in cash. So in this case, Coca-Cola is above the 200 MA. And if you recall, right, just because the price is in an uptrend doesn't mean we buy immediately. Why is that? Right, because the second thing that we look for is, right, can you remember what's the second thing? So first thing is trend. Okay, trend we know is up, price above 200 MA. Second thing is the area of value. We want to buy when the price is at an area of value. And in this case, if you notice, right, price has bounced off the 200 MA once, twice, and now it's here for a third time. And not only that, right, if you notice, from a market structure perspective, this is a resistance, 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 resistance. And when the price breaks out of resistance, it tends to come back and becomes previous resistance becomes support, right? That's some additional technical analysis tidbit for you if you're unaware, right? Whenever price breaks above resistance, it tends to retest previous resistance, which will become support. And if price breaks below support, right, that level of support, that area of support would become resistance. So in this case, right, clearly the price is also at an area of value. And now the third thing, entry trigger. Do we have an entry trigger that tells us that, hey, the buyers are stepping in, right, about to push price higher? So if you look carefully, right, over here we have a bullish reversal pattern, right? I think it's called a piercing pattern, where you can see that the candle opened near the lows of the days. Buyers stepped in, pushed the price higher, closing at the highs of the day, almost the highs. Okay, so this is a sign of strength from the buyers. So we have four things. Number one, fundamentals are good. Number two, trend is up. Number three, from an area of value. And number four, we have a strong bullish reversal pattern telling us that, hey, buyers are in control and the price could possibly head higher. But if you recall earlier, risk management is important, right? Because you can have a profitable trading system or strategy, but without proper risk management, right, you could still, lose in the long run. So now the question is, how do you put on a trade such that if the trade sours, such that if the trade, goes against you, you only lose a fraction of your trading capital or 1% of your trading capital? So how many shares of Coca-Cola do you buy? Okay, so before we can answer that question, right, we have to ask ourselves, where is our entry point? Right, to keep things simple, let's say our entry point is at $47. And let's say we have a stop loss at $45. So with that in mind, just pull out your position sizing calculator. Can Google it. It's there's a lot of free ones out there. Let's say again you have a capital of $100,000, and again you're conservative, you risk 1%. Buy price $47, stop loss $45. So in this case, you can buy 500 shares of Coca-Cola, okay? And if the price hits $45, if it hits your stop loss, right, you will lose $1,000 on the trade, which is 1% of your trading account. Okay, so you can see that over here, Coca-Cola, you can buy at $47, which is this. Let me just get out the tool over here. $47. Change this to green, and I'll put this one in red. Okay, red color. Okay, so you can see over here, this is my entry price. Right, about 47. Let me just adjust it, 47. And this over here is my stop loss at 45. I'm not going to be anal with this, right? So you get it, right? This is the entry point. This is the stop loss. Okay, so this is how you actually, kind of piece the puzzles together, right? From looking at, technicals, risk management, and then, position sizing such that you don't blow up your trading account. So one aspect that I've not really covered is your exits. Where do you exit your trade? So now this is a very broad topic. We can, discuss this until the cows come home, right? Right. So, but generally, right, you want to exit your trade, right? Let's say you're a swing trader, right, where you just want to capture one swing in the market, just that one move, one move, right? As a swing trader, what you want to do is to exit your trade, right, where there is potential selling pressure, or where potential selling pressure could come in and push the price lower. So you want to ask yourself, at where on this chart, right, would selling pressure come in and push the price lower? So if you ask me, right, again, I like to reference to market structure. I would say that this is a possible level and this one over here. Because this one over here could possibly become previous support, right? That could act as resistance, something that I just covered earlier. And this over here is just an obvious resistance level smack into the $50 price range. So if you ask me, a possible level that you want to consider taking profits could be this is your first level, and this would be a second level to consider. Okay, so this is how you can go about, exiting your trades. Of course, this is just one approach, right? It's from a swing trading approach. You can adopt a trend following approach as well, where you try to, write trends in the market. But again, it's not within the scope of this video to cover it. If you want to learn more, I can point you to some relevant resource towards the end of this video. But for now, right? I hope you have a good example, right, of how you can actually, take the knowledge that you have learned so far, right, and apply it to your own stock trading. Okay, so of course, do it on demo paper trade first. All right, once you're confident, right, then you can take it to the live markets. All right, so with that said, let's move on.